Right on top of this edition of India Tonight, we talk about Fed Chair Jerome Powell. Last evening, we heard him reaffirm that they would need to hike rates further. He did, though, in a caveat, say that it would all depend on incoming data. He did mention, too, that they have an eye out for macro indicators that has really been pushing the central bank to increase the pace of rate hikes. And just a short while ago, we got some indication from the weekly jobless data that was put out by the Labour Department. The bigger than expected rise in jobless claims. Now that further eases concerns about a sharp rise in interest rates. Initial filings for unemployment benefits for the week ended 4th March. Now that has come in at 211,000, which means there is an increase of 21,000 from the previous period. And yes, we are seeing Wall Street react to those numbers as well. There has been mixed trade on Wall Street. For that, also all eyes are on the non-farm payrolls report, which will be out tomorrow. But for the moment, you're seeing the Dow Jones jump about 0.5 percentage point in trade. Jerome Powell clearly has spoken about this in the House briefing, that there was no decision yet about the course that could be taken for the March meeting. Here's what Jerome Powell, the Fed chair, has said.
Larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook. It's, certainly conducted under Vice Chair Barr's leadership with input from the staff and, discussions with governors on that committee. And I'm kept broadly apprised about what's going on. But the bottom line is nothing has been proposed to the board. Nothing has been formalized at this point. It's a lot of work that's going on. I think discussions are going on, meetings with industry and that kind of thing. When we get to the place where that's appropriate, the board will be carefully briefed. Ultimately, we'll vote on a proposal. We have no role and seek no role in what is really at the heart of fiscal policy, except I will limit myself to the two things that other Fed chairs have said about this. One is just that Congress raising the debt ceiling is really the only alternative. There are no rabbits in hats to be pulled out on this. Two really is just that no one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here. But no one should be thinking that we have the tools to protect the economy from all the potential effects of that.
That too is an important line that the Fed chair has said, and of course we'll get perspective on all of this. Craig Erlam is joining us, senior market analyst at Whelan, along with Sharmila, Whelan, global macro strategist at Westbourne Research Services. Great to have you both on the show tonight. Sharmila, first to you. There seems to be this slight softening in labor market conditions. This latest data that we're looking at, 211,000. We seem to be at the highest level of jobless claims in the US since the month of December last year. So the resilience of the job market, Sharmila, against interest rate hikes, that was a point of worry. How much do you think this data is going to help the Fed and its fight against inflation?
Vikram, call me bearish, but I think it's going to have very limited impact on the Fed's decision. The Powell and the Fed are very, very much focused on inflation and getting it below 2% or towards 2%. And the things that are concerning them that more than overwhelms any softening in the labor market are two things. One is the personal consumer expenditure price index. For January, the readings showed an acceleration both in the headline and the core. And within that, if you look at services, there's no deflationary pressures coming through there on the core services. That's number one. Number two is wage growth and the tightness of the labor market. Wage growth has slowed somewhat, but the Fed is very clear that this is not consistent with their inflation target. So to me, it's the softening of the labor market is not going to cause the Fed to reverse course on what they've said earlier this week in the Senate hearing.
Yes, absolutely. Craig, the Fed chair clearly also said that it is for the Congress to lift the ceiling on debt and that it's the only way forward to allow the federal government to meet its obligations. And we just heard him say again, no one should expect the Federal Reserve to be able to shield the economy from the effects of a failure to do so. The Fed chair clearly has raised his hands when it comes to safeguarding the American economy. But tell me how the street has been digesting this.
Well, I think for a long time now, the street tends to more or less ignore it, to be quite honest. And the reason is that this political back and forth happens and can happen for many months. We see the Treasury go in to find extraordinary ways in order to try and survive a little bit longer. And as the deadline approaches, the two sides come together and a solution is reached. It's all about trying to maximize the leverage ultimately, especially for the opposition party. And therefore, I don't think either side is actually seriously considering allowing this to pass. The Fed chair has warned that they couldn't limit any overspill that happens as a result of it. But also, I just don't think the US, in the longer term, has any desire to allow that to happen, and that's Republicans and Democrats alike. So I think we should try and ignore the kind of the public back and forth because neither side has anything to gain by letting this happen.
Fair enough. Sharmila, the Fed chair also has indicated that there has been no call made on the size of the March rate rise. How do you think the Fed is going to act on the March rate rise and the subsequent raises after that? Where do you expect the rates to peak as well, and by when?
I mean, the Fed has been front-loading interest rate hikes, right? We've seen about 450 basis point hikes so far in the last 1 year. Fed fully acknowledges, Powell has fully acknowledges that the full effects of this is yet to feed through, but at the same time was very clear in saying there is still work to be done. And I think they will continue to front load. So I would be looking for 50 basis points at the next meeting. Where is the Fed funds rate going to peak? Well, that's the million-dollar question for markets and investors, but I wouldn't be surprised to see the Fed fund rate go up by about 75 to 100 basis points from where it is today.
Do you agree with what Sharmila believes? What are the estimates you're working with when it comes to the pace of rate hikes, and how much of a rate rise are you likely to see in March and subsequently? Also, the peak rates, what are you working with?
So, I mean, I guess when you look at Powell's comments this week, he certainly wants people to believe that 50 basis points is on the table. And I think it is on the table. But, I mean, we get a lot of economic data now over the course of the next 2 weeks, starting with that jobs report tomorrow. And that's going to determine whether we see 50 far more than the January data. The January data, a lot of it seems to be driven by unseasonably warm weather. So it's about how this data points correct itself will determine whether we see 25 or 50. I think the Fed chair just wants everyone to be aware that 50 is very much on the table. If we see a soft jobs report tomorrow and we see something more that like we were seeing pre-January, for example, in the inflation and retail sales figures and a few other data points, I don't think the Fed will hesitate to go 25 again, because that's the path that it's on. There is a lag that comes with monetary policy, which means that it's something that they need to be careful about. But ultimately, they are going to be concerned that that we're not seeing this filter through fully to the inflation numbers, as has already been highlighted. The core services inflation, I think, is one very important area within this that's causing the Fed plenty of discomfort. And until we start to see that, they're not going to take the foot off the brake. But I think personally at this point in time, unless we see another series of hot jobs reports and retail sales, inflation, etc. for February, I wouldn't be surprised to see them stick at 25, because they know there is a lag in place. And I think they would rather now move at 25 increments until they hit that peak, which could be, like I say, anything from 50 to 100 basis points. And I know that sounds like I'm sitting on the fence here, but I'm trying not to get carried away by the January data, because I do think it will turn out to be a blip in the longer term trend of the data over the last 6 months, more so than a sign of things to come.
Also, you think it's going to be a blip, at least as far as January data is concerned? We'll have to have more incoming data to see exactly whether a trend is building up or not. But after the statements by the Fed chair, Sharmila, the bond yields, they jumped. The stocks, they fell. The dollar has extended gains, but now we are seeing recovery in the markets. A faster rate tightening by the Fed, Sharmila. How are investors bracing for the ride on Wall Street? Do you see opportunities for that? And if so, which are the pockets that you expect will do well?
That is a difficult question. I mean, what is a given is that we're going to see a lot of volatility in the markets, right? All signs, as Craig said, the January data is likely to prove a blip, and I agree with Craig there. But if you look at underlying, whether you're looking at the housing market, if you're looking at manufacturing shipments, data the economy is slowing, right? And that's still to feed through in earnings growth forecasts, which is not fully discounting yet the slowdown or the downturn that is coming in the US. So if that is my view, that the US is headed for a downturn, then we're looking at defensive stocks. I would be staying away from discretionary, and I would be staying away from growth cyclicals. For safety, I'm looking at government bonds. US dollar, obviously, today it's a bit softer, but as the market digests all the news that's coming out, but the fundamental that interest rates have not peaked yet in the US will continue to give support to the dollar, in my view.
Greg, do you also believe that it's time to hedge your risks, bracing for the volatility that is likely to come? What's your opinion?
Yeah, I agree, to be honest, and for two reasons on top of everything that's just been covered, to be honest. One is that I think the way markets moved since the start of the year was way too optimistic, getting far too carried away with a couple of data points in the same way that as we kind of have in the reverse direction over the course of the last month. I think the moves that we saw at the start of the year were far too optimistic, and I don't think we've really corrected that. We've pulled back a little bit from the peaks that we saw in the aftermath of that quite tremendous rally in equity markets, but we haven't really seen that much of a reversal at this point. Even though we have seen corrective moves elsewhere in the markets, bond markets, commodity markets, they're all adjusting to the reality that the US economy may have to be slowed further, rates will have to rise further. The equity markets, I don't think, have adjusted to that reality. Maybe they're waiting to see how the February data plays out, to see maybe there is this bit of FOMO still lingering on from the last decade of not wanting to move out just at a time when things pop higher again. I think if we see a couple of disappointing figures, then we could see that happen. But I think at this point in time, because more rate hikes are being priced in, and reasonably so at this stage, and I think there's still a lack of clarity on the economy, but it seems that the Fed is going to continue to drive it slower in order to attain its ultimate goal, then I'm in total agreement. Because of the way these markets have started the year and the clarity that we currently have on the path forward, I do think a more defensive play is sensible at this stage.
About cryptos, because there is an air of caution, and that has never really gone away. Sharmila, Powell on Tuesday has laid out a series of concerns with cryptos. He says lenders, as far as the regulator is concerned, must take great care when engaging with cryptos. He's also said that the central bank did not want to prevent innovation, but more or less this line that he's taken on cryptos, what does that really mean for those who invest in cryptos, for the many startups, the crypto startups here in India as well? There are quite a few.
Well, Vikram, I am no expert on cryptos. That's for, I think, the younger investors, that Generation Z and millennials. What we can see is that two things. One is the regulations are coming in for crypto, right? It is an asset class that increasingly going forward will come under the regulatory umbrella. That's got its upsides and its downsides, but it needs to be safeguarded. That's number one. Number two is, but in terms of cryptos as an asset class, right now I would not be an investor of cryptos, because it is a high risk, a marginal asset class. It doesn't have the depth or the liquidity of market. And if we are in a global scenario led by the US, where global liquidity is being withdrawn, that affects all markets, and particularly the marginal assets like crypto. So I think it is a risky one to be holding, unless you really truly believe in blockchain and you're got a long-term view on cryptos.
What's the trajectory that the US dollar is likely to follow from this point onwards? Craig, what's your understanding also on gold?
So, I think, like I say, without wanting to sit on the fence, the economic data over the next 2 weeks is going to be so crucial. We're going to get a lot of big data points, which is going to determine whether the dollar's going to go higher. One thing I would say is that a lot is being priced in now on interest rates. We're looking at 4 rate hikes this year, or 50 basis points in 225s, but that's almost, from a market's perspective, a full percentage point effectively above where we are. So unless anyone is expecting more than that, and that could materialize, we've been surprised plenty of times over the course of the last 12 months, then for me, that potentially limits some of the upside that we could potentially see on the US dollar in the longer term. But in the short term, it just takes a hot jobs report tomorrow. If tomorrow we see 400,000 jobs added and no negative revisions, which is not what I expect, I should state. But if we do see that and we see strong wage growth, then sure, the dollar can go higher, gold can go lower, gold can break 1,800, and we could see a couple of very nervy weeks. But the flip side to that is tomorrow, as we've seen so many times, could bring not just a cooler jobs report and put at ease those concerns, but it could also bring some revisions. We've seen some sizable revisions to jobs data in recent months, and when you see a number above 500,000, for me, that just screams as prime for a significant revision. We'll have to wait and see whether that materializes. So in the short term, if the data allows, then sure, the dollar can go higher, gold can go lower. But I think over the medium to longer term, I am of the view that we probably are, that the position that is currently seen right now in the markets is probably not aligned with what the longer term trend is, with what long term trend as far as interest rates is actually going to be. And I do think the next 2 or 3 months we are going to see the economic data reflect the sheer level of tightening that has now taken place in the US, as has already been highlighted earlier on. The housing market is in recession. Other parts of the economy do appear to be in recession. There's just a couple of extremely resilient areas which are not quite slowing down to a significant enough extent yet. I do think we are going to see that slowdown.
Absolutely. The Fed, of course, began that aggressive attempt to control inflation, raising the benchmark lending rate a year ago. Some would argue that they were slow on the uptake, but they've moved to a range of 4.5% to 4.75%. Yet the U.S. economy has proved to be strong. It has shown resilience. Payrolls have gone up by more than 1 million jobs in the 3 months ending in January. And even this recent consumption and inflation data point towards persistent price pressures. So we'll keep monitoring what the Fed does, etc., as far as their rate hikes are concerned, the pace of rate hikes, where exactly they're going to peak. All of that, the jury is still out. But Craig and Sharmila, we'll keep touching base with you. Thanks very much for your insights. Thanks for joining us on India Tonight.
Thank you.